Hello friends, this is the first video in the series of videos covering the different topics of Islamic finance and banking, and in this very video we shall be discussing about the basic concepts and fundamentals of Islamic finance. And this is brought to you by Renascence Educational Empowerment for Awareness and Awakening. The topics that we'll be covering in this very video include the paradigms of Islamic banking, its terminologies, principles, history, how is Islamic banking different from conventional banking, overview, performance of various Islamic banks, the business model of a conventional as well as an Islamic bank, SWOT analysis, what the future holds for the Islamic banking industry, the key challenges facing Islamic banks, its success, and recommendations. Now, what is Islamic banking? Islamic banking is a system of financial activities which is consistent with Sharia. It is based on Islamic principles which at the core refuses collection of interest and transactions involving in uncertainty and speculation. It is based on the Islamic economic system, and the good news is it is not just restricted to Muslims only. Let us look into the different terminologies of Islamic finance and banking. To begin with, we have Takafful, which is Islamic insurance. It is an alternative form of cover that a Muslim can avail himself against the risk of loss due to misfortunes and calamities. And then we have the Sukuk, which is an Islamic bond. It is basically the Arabic name for a financial certificate, but it can also be viewed as an Islamic equivalent of a financial bond. The modes of Islamic finance can be differentiated in three broad categories, like partnership, trade, and rental. The partnership-based mode includes Musharaka and Mudaraba. The trade-based category includes the product called Murabaha. And finally, under the rental-based category, we have Jarrah. Moving on to a different terminology of Islamic finance, which is called Murabaha. Now, Murabaha is a contract for purchase and resale, and it allows the customer to make purchases without having to take out a loan and pay interest. The bank purchases the goods on behalf of the customer and resells them to the customer on an agreed profit margin. And all the customer has to do is pay the sale price for the goods over a period of time in the form of installments. And we have Musharaka. Now, Musharaka, it simply means a partnership. It involves you placing your capital with another person, and both will be sharing the risk and reward in a pre-agreed profit-sharing ratio. Now, remember that the losses in the case of Musharaka must be proportionate to the amount invested. Mudaraba. Now, Mudaraba refers to an investment on your behalf by a more skilled person. It takes the form of a contract between two parties, one which provides the funds and the other who provides the expertise, and they both agree to divide the profits in advance. For example, the bank would make Sharia compliant investments and share the profits with the customer, in effect charging for the time and effort. If no profit is made, the loss is borne by the customer and the Islamic bank takes no fee. Ijara. Ijara is a form of leasing. It involves a contract where the bank buys and then leases an item. For example, auto ijara, which is simply an agreement under which the vehicle shall be given to you on rent for a period agreed at the time of the contract. The bank purchases the vehicle and rents it out to the consumer for a period upon the completion of which the consumer gets ownership of the vehicle, and of course through a separate sale agreement. Principles of Islamic finance. Islamic finance works on Islamic set guidelines consisting of risk sharing, individual rights and duties, property rights, purity of contracts, commitments, transparencies, and fair deals. Any predetermined payment over and above the actual amount of principal is actually prohibited in Islam because that is what is called interest or riba. The only loan that the doctrines of Islamic finance allow is Qardul Hasana or Qardul Hasan, wherein the lender does not charge any interest for the amount because profit cannot be made explicit in Islam, and even money has no time value. The Islamic financial system employs the concept of participation and utilization of funds on a profit and loss sharing basis. Let's have a glimpse at the history of the development of Islamic banking institutions. The pioneering effort led by Ahmad al-Nagar took the form of a savings bank based on profit sharing in the Egyptian town of Midghammer in the year 1963. And this experiment lasted till 1967, by which time there were 9 such banks in the country. In 1973, the Islamic Development Bank was set up. The first Islamic bank in Malaysia was established in the year 1983. In 1993, the commercial and merchant banks were allowed to offer Islamic banking products and services under the Islamic Banking Scheme or IBS. These institutions, however, are required to separate the funds and activities of Islamic banking transactions from that of the conventional banking business. The Islamic Summit of Lahore, Pakistan was held in the year 1974, which recommended the creation of Islamic banks and the Islamic Development Bank. On the 14th of Ramadan 1420 Hijri, the Sharia bench of the Supreme Court of Pakistan gave its landmark decision banning interest in all its forms and by whatever name it may be called. The court also specified a step-by-step approach to rid the country of the evil and menace of interest. How is Islamic finance different from conventional finance? Well, Islamic finance orders not to use money as a commodity. Islamic financial products operate under the concept of lender-borrower relationship, and the profits generated through this relationship are divided between the two parties as per the agreement. How does an Islamic bank work? Now, an Islamic bank entirely depends upon the fixed deposits and does not borrow money from the central bank. The bank gives loan on basis of mutual agreement, and it majorly focuses on sales transactions.